So in this video, we're going to take a look at three types of entry orders used in the stock market. Michael Thompson, JB Market Advisor and Analyst. Before we do so, let's cover a general disclaimer and we can go into and have a look at what orders types they are. So anything we cover today is going to be for general advice. It doesn't take into account your objectives or financial needs. And also any past performance is not a reliable indication of future performances. So let's have a look at what these order types are. Now, for those who are very new to the market and are very wanting to buy place a simple order to buy at market, this is the common one used by investors and traders, simply to get the price at the current level. So whether you're buying or you're going the opposite direction, this order type is to get you in filled at the current level now. Now, with some brokers, you're also allowed to actually put the order before the market opens. And this will mean that, for example, on market on open, you can send the order to get filled, but only at the opening price. So that means it's restricting its time based and time sensitive. It will get filled you on the morning opening price, which is part of the pre-auction level, auction price I mean. The opposite is that some brokers will allow you to send also a market on close, which is the direct opposite. So if you're running a strategy where you don't want to hold overnight, you then want to get out at the end of the trading session. Now, depending on the exchange and the broker, it's usually available through the US market, Australia. We don't have these ordered as per se. You have to get into the auction. So it means you have to put a price in and it'll get calculated. And if your price meets the close settlement price, you'll get filled that price. If not, you will not get that price. Same occurs with the opening price. You have to have the ability to participate in the auctioning. But in generally, what this order means, you're going to buy at the current price levels. The only thing about this advantage with this order type is those who've been in the traded the market or bought stocks at this using this order type is that during volatile conditions, or especially if you're buying illiquid stocks, you'll find that because you're placing at market, the prices can move from what the price you saw at that. Let's say you want to buy it at $10 even, and you saw the price available at $10. Once you place that order, between the time you send that order and it gets received by the exchange and it gets executed, you could get $10.05. So if during volatile conditions, it's not really ideal unless you're just more of a long-term trader or investor and you don't mind taking a little bit of slippage, which is the price unfavorable to what you wanted at, then you may still use this order type. But that's the most basic of all orders. So the buy at market is to get at the current price. Now let's take a look at the next order type, which is quite common too. Now a lot of investors are familiar with a limit order. So a limit order, whether you're buying or selling, is at a specific price level. So it's a conditional price level set. So the idea of a condition order is to buy at the current price, set at the specific price, and if it hits that level, you'll get filled. If, for example, when you're buying, if it falls below that, so you're waiting for prices to drop, and then you'll be buying it once it hits that level. So you're trying to buy it, I guess loosely use the term cheaper. Now, this is very common for investors that accumulate stocks over time. They simply want to buy it, set at a low level, so if the prices come down, they want to pick it up at a cheaper price level. Now the opposite occurs when you're selling it at a limit. Now if you're trying to sell the market, it means you're waiting for it to rally up a little bit and you want a more favorable price. So you're buying against the short-term rally. Sorry, you're selling at a short-term rally, hoping that it will fall further. So that's what a limit sell would do, the direct opposite. Now it's great for actually it's great for getting it at a price level favorable to what you want it at. So that's what is a common order type, where if you don't want the slippage as such, you would use a limit order and prices need to move in your direction or favorable to your side before you can actually get filled or executed that order. Now let's have a look at the charts, and this will make some sense. Those who are familiar, obviously you know how to use this order, but here's an example of a buy limit set at $79. Now we're looking at CBA, just as an example, Commonwealth Bank. Now as of the chart, you can see the last trade was at 81.28 on the close of that day. We set a buy limit at 79 here at this almost $2.22, exactly $2.28 away. So if the prices travel down and got to this level, it will put an order in at $79. Now, if for whatever reason CBA had an announcement or something that affected them, earnings or so, and it gaps open down below here at say 70, 77, 75, that means you would get that price level. So it means that you'll get the level that or below. So it must reach a minimum of $79 in the event of a gap where announcements has caused the prices to be trading much lower at the opening. You will get the relevant price, whatever fill at that level liquidity is there. So if it opens up at 77.50, you'll get that price or slightly lower depending on the movement of the market. So that's the minimum, means you get 79 or better depending on the opening or the gaps that occur. Now that's the buy limit side. Let's take a look at the sell side. Sell side is direct opposite. If you're shorting the market and trying to profit for prices on the way down, you'll need prices to rally up, get to at least in this case $83. So the last was 81, CBA still 81.28. If we keep going higher or get to 83, the order will be then sent to the market 83. Same condition occurs if it does open up higher at say 84, it gaps up, you will get the 84 level. So that's the opposite side of the buy limit, the sell limit side. Now the order type we use more often for our momentum reports is a stop order. Now there's a lot of investors that are not familiar with this order because most people don't tend to trade with momentum. So they may have not used this order before. So whether you're using momentum, breakout, this order type is also a specified price. And the difference is that once it hits that level, it gets executed at the market. So all we're trying to say is that if we get to this certain price level, we will be putting a market order into the market to get filled. So we want prices to be moving in the direction we want to be buying or selling, and we'll then execute our order. So on the buy side, it needs to be set above the current price, and we need to get to that level or higher, and we'll set our order to buy at market. Direct opposite for the sell orders, we go the opposite side. If the prices have been falling, it has to reach the price level we set it at, and we would execute at market. Now, a little bit more to this is that there's a secondary order, or you could say another type of stop order. The difference here is we limit the price. Instead of getting a market order fill when we hit our price level, we actually want to limit the price. So we'll go and have a look at that on the chart. The same sort of conditions or strategy would apply, meaning we're still looking for a breakout strategy or a type of momentum. And the difference here is we want to avoid large gaps and unfavorable pricing. So let's have a look at the chart to see what that looks like. So a CBA example again. Now you can see this is a direct opposite to the limit order. So we're setting a buy stop at $83. Now if prices are trading below at the last close of 81.28 and it opens up and for the next day it stays below $83, we will not buy. We will not be placing an order at the market to buy. However, if prices does rally and go higher and then gets to $83, we will then place an order to buy at market. So if it gets there at 83 and it's not too volatile, it's a very liquid stock, you usually get very close to the 83. However, in conditions where they're volatile and maybe the announcement occurs, this is where the buy limit comes in. So an example of a buy stop buy limit, what we're setting, we set our conditions to say we want to start placing our order once we get to 83. Now in the condition of a limit, we might limit the price to say, however, if it does get to 83, we don't want to get the market order. We want actually a price no worse than 84. So let's say we set in an 83 condition, say if we reach 83, we want to get a price to buy no worse than 83 $84. So that means that our order will then be sent to the market at 84 as a limit. So what happens first? Price will come through, hit the 83 level. Now, if prices are trading for that day, you usually get filled because this liquid will get filled closer to the 83 or whatever the condition, the limit has been set at. If we set at 84, we will get typically the 83 or a little bit more depending on volatility. In the event though, if the market opens up, whether it's an announcement or CBA opens up at $85 though, and it's above our limit of 84, we would have the order sitting there waiting for a buy at 84. Now, if the rest of the day it trades above 84, so it's opened up at $85 up here. So 85 there, and we've got a limit order at 84. So that means unless it comes back down to the 84 limit, this order will not get filled. So that's the difference, is that with a buy stop limit, we're limiting the price that we want to get filled at. So we're not using a market order upon the condition being met. So that's the difference. So if you are sensitive to price, let's say you're more of a short-term breakout trader and you're holding for a day, maybe less than a week, and you're sensitive with the price, means that your strategy is very sensitive to the price level that you want to enter at. So you restrict that by limiting the level that the execution of the price is filled at. So that means you get a lot more closer to where the price level that you set at, as opposed to a market order, and your longer term, you just want to get the price. You don't want to miss out the direction. That typically is more of a time frame to do with the strategy, because you have more room to allow for a bit of slippage. The direct opposite for the short is the opposite side of that. So the condition is the same. We set a sell below market, so we're waiting prices, which is what our momentum hedge report does. We set a price for it to sit below the current closing at 81.28. So we set it at $79. So if prices don't come down further towards the direction we want to be entering, we do not get filled. Same condition occurs if it gaps open and it opens lower at $77. We get the market, whatever the current market is. Now in the limit order, same condition applies. We may say we don't want to get filled worse than, let's say, $76. So anytime this, as long as we go through the $79 level, which is our trigger, a level that we want to start putting our limit order in, our sell stop limit order will limit the price that we get the worst case. So that's the order types that we use. Have a look at these orders because they're really relevant on the type of strategy you run. But for all our momentum style reports, we use stop orders. We don't use a stop limit. You can if you wish. However, you can miss opportunities. And generally with the markets that we trade, we rather be in the position than to miss out. But as I said, this has its purpose. It does limit the price so that you have a lot closer to the level that you want to enter at, and you're not too the price is not too unfavorable and doesn't disadvantage your strategies per se. That's all for this video. I'll see you guys in the next one.